Welcome to Morphic Labs, and today we are going to be discussing beyond Sharpe, what quants actually care about. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. I will greatly appreciate it. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your overall market intelligence. But who am I to tell you what to do? But if you're interested, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics. Plus, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven and hybrid methods, plus implementation and selection criteria. If you're interested, the links are in the description. You just gotta sign up to be a free member, and you have both of these resources all to yourself. Now let's get into it. Chapter 1. Today we're going to be discussing the Sharpe ratio problem and why the Sharpe ratio is jokingly useless. The Sharpe ratio, introduced by William F. Sharpe in 1966, has become the most widely cited risk-adjusted performance metric in finance. Defined as the ratio of excess return per unit of total volatility, it enjoys near universal adoption among allocators, consultants, and retail investors. Yet within the quantitative community, the Sharpe ratio is treated with suspicion, bordering on contempt. This section explains why. Definition 1.1 Sharpe ratio. Let R sub P denote the portfolio return, R sub F the risk-free rate, and sigma sub P the standard deviation of portfolio excess returns. The Sharpe ratio S is defined as S equals R sub P difference R sub F over sigma sub P. The Sharpe ratio suffers from three fundamental defects that render it inadequate for serious quantitative analysis. First, it penalizes upside volatility symmetrically with downside volatility. A strategy that generates large positive returns punctured by small losses. Pay attention now. This is the important part. I'm gonna start again from the second part, the second sentence. A strategy that generates large positive returns punctured by small losses receives the same Sharpe ratio as a strategy with consistently small positive returns and catastrophic losses, provided the total variance is identical. Quants recognize that their upside volatility is not risk in any economically meaningful sense. Number 2, the Sharpe ratio assumes returns are normally distributed, which in the real world is far, far from the truth, right? Empirical financial returns exhibit negative skewness and excess ketosis. If you don't know what these fancy words mean, just Google it. And if you want me to touch on time series analysis and stochastic processes, just let me know in the comments. I'll maybe talk about time series and stochastic processes in the future. But as I was saying, a strategy with negatively skewed returns may exhibit an attractive Sharpe ratio for extended periods before a single tail event erases years of gains. And you see this a lot when hedge funds implode, right? They've been doing well for 5 years, 10 years, and out of nowhere, just one loss destroyed the entire hedge fund, right? Or when there's a market crisis, let's say the market moves in a way that most market participants really didn't assume because they're assuming a normal distribution, right? And it catches them off guard, right? So that tail event just evaporates the entire hedge fund or the entire portfolio in a matter of seconds, right? And the reason for this is because they're using the wrong risk metric. The Sharpe ratio is blind to higher moment structure of the return distribution. Number 3, the Sharpe ratio is not robust to path dependency. Two strategies with identical mean return and standard deviation may expose investors to radically different maximum drawdown profiles, depending on the autocorrelation structure of their returns. Investors experience losses in the time domain, not in the cross-sectional distribution. A practitioner's warning. A Sharpe ratio above 1 calculated on less than 3 years of data tells you nothing about the probability of ruin. It is a retrospective summary statistic, not a predictive risk measure. The quant's question is never what was the Sharpe ratio, but what is the probability that this Sharpe ratio is a statistical fluke? And what is the worst path I might experience? Now, the difference between the first question and the second is that the first question is naive. It's assuming that just knowing the Sharpe ratio tells you something about how the strategy is going to perform in the future. Let me give you a wake-up call. It doesn't tell you anything, right? Especially if the data is less than 3 years, right? The second question, what differentiates it from the first, is that this is a scientific question. And because it's a scientific question, it can be approached scientifically with rigor. The remainder of this document presents the metrics and mathematical frameworks that professional quantitative traders and portfolio managers actually use to evaluate strategies, construct portfolios, and manage risk. And that's about it for today. In the next video, I'll be talking about expected value and mathematical expectancy, the Kelly criterion, and position sizing. And that's about it. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course that will walk you through foundations of market structure, the mechanics of trading, market data, and analytics. Plus, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven hybrid methods, plus implementation and selection criteria. If you're interested, the links are in the description. You just gotta sign up to be a free member, and you'll have both of these resources all to yourself. And that's about it for today. I'm out. Bye.